Welcome to the Deep Dive. We're the show that grabs the facts, cuts through all that noise, and, well, delivers them straight to you. Our aim: to get you truly smart on some of the most exciting, sometimes really mind-bending topics out there. And today, we're definitely doing that. We're soaring into a future that, honestly, used to feel like pure science fiction. But it's becoming real fast. We're talking about urban air mobility. Yes, flying cars, folks. Personal air vehicles that could totally revolutionize how we move around cities, no longer just in books or movies. And right at the cutting edge of this incredible shift is a company called Joby Aviation. So for this deep dive, we've really dug into a recent financial analysis report focusing squarely on Joby, our mission today. To unpack this report piece by piece, we want to understand where Joby stands right now in the market, sure, but also really grasp the deeper factors shaping its path, especially after it went through a pretty significant, though short, market pullback recently. We want to give you the clearest possible picture of what's happening, not just with Joby, but in this whole new high-potential space.
Right. And I think it's important for you, the listener, to realize this analysis isn't just about, one company's stock price going up or down. This report, it's actually a fantastic lens. It helps us understand the why behind Joby's market moves, but crucially, within the much bigger picture of the whole eVTOL industry, that's electric vertical takeoff and landing. And we'll also pull out some practical insights on investment strategy from it, which is always useful, right? We've basically done the heavy lifting, dissecting the nuances in this source material. So think of this as your shortcut to getting genuinely informed on this really captivating, complex, and potentially world-changing sector. You won't just get facts, you'll get understanding.
Okay, let's unpack that vision then, this idea of urban air mobility, UAM, and these eVTOLs. What are we actually talking about here? Because flying car...
Yeah.
It still makes me think of, I don't know, the Jetsons or something.
Yeah, the image needs an update. So eVTOLs, at their core, are aircraft specifically designed for electric vertical takeoff and landing. Imagine, maybe, a cross between a helicopter and a very sophisticated large drone, but built from the ground up for carrying people or cargo, mostly within or between cities. And the key differences are huge. They're engineered to be much, much quieter than helicopters, way more energy efficient, and critically, much greener. They run on electricity, zero emissions during operation. So the bigger vision, UAM, is about weaving these vehicles into our cities, adding like a whole new layer to how we get around up in the sky for short hops.
Right, so instead of being stuck in traffic for an hour to cross town, maybe a 10-minute flight.
Exactly.
Or like urgent medical supplies flying straight to a hospital roof. Or getting goods into dense areas without clogging up the streets even more. It sounds
amazing, actually.
Less congestion, new ways to think about logistics.
Well, it really does open up possibilities. And the reason this is happening now, why it's not just a dream anymore, is because several things are coming together. First, the tech. We've hit a real tipping point. Battery technology, especially energy density, has improved massively. Electric motors are super efficient now. We have advanced lightweight materials, and the flight control systems, even autonomous capabilities, are getting incredibly sophisticated. So the engineering is finally making these designs practical, not just possible. Then there's the environmental push. The global demand for cleaner, sustainable transport is undeniable. eVTOLs fit right into that. They're a potential zero-emission alternative for short trips. And finally, just the sheer need for better urban transport. Our big cities are choking on traffic. It costs time, money, quality of life. Companies like Joby, they're aiming straight at that problem, offering a whole new way to move. But, and this is a big but, pioneering something this new is incredibly hard. The challenges are immense. Developing the tech is one thing. Getting it certified is another huge hurdle. Building the regulations, the infrastructure, scaling up manufacturing, it's definitely a marathon.
And Joby Aviation, that's Joby on the New York Stock Exchange, is definitely one of those marathon runners right out in front. The report we're looking at positions them as a major contender in this whole eVTOL race. Now, according to our source material, when it was written, Joby was trading at $16.16 a share, and his market capitalization was around $14.17 billion, $14 billion, for a company that, as you said, is still developing its main product. That seems pretty staggering. What does a number like that actually mean at this stage?
It is staggering, absolutely. And what it signifies really is belief in the future. Massive belief. If you put that $14 billion market cap in context, especially for a company not yet generating significant revenue, it signals extraordinary investor confidence. It's not just about where they are now. It's like Wall Street is saying, okay, Joby isn't just making an aircraft. They're potentially creating a whole new industry, maybe worth trillions down the line, and we think they're one of the best bets to lead it. So, investors are essentially placing a huge long-term wager on the future success of urban air mobility, and they see Joby as having a major head start or advantage. That market cap is a powerful vote of confidence in their technology, their team, their strategy, and their ability to actually pull this off despite all the challenges. It suggests the market thinks they have a real competitive edge. Hashtag tag 1.3 the recent market correction.
Okay, but here's the twist. Despite that huge confidence, that massive valuation, the report points out Joby recently went through a short-term pullback, a price correction over about 2 weeks. And it happened right after the stock hit some kind of June 7 target. The report hints this might have been just profit-taking, or maybe a normal market adjustment. So what exactly is a short-term pullback, and is it something to worry about?
That's a really important question. And no, a short-term correction isn't automatically a bad sign for the company itself, especially not for these high-growth, innovative stocks like Joby. Think of it like the market taking a breath. These stocks can run up really fast, like Joby did leading up to that June 7 date. When that happens, it's totally normal for some early investors to decide, okay, I've made a good profit, time to sell some shares and lock it in. That's profit taking. And when enough people do it, it creates selling pressure. Sometimes that pressure can break technical levels on a chart, maybe trigger some automatic selling programs, or just make other investors pause. But it's often just the natural rhythm, the ebb and flow, particularly for stocks that have had a strong run. The key is to look beyond the short-term price wiggle and ask, have the company's fundamental prospects changed? Usually in these pullbacks, the answer is no. It's more about market dynamics, investor psychology, maybe some rebalancing. Not necessarily a sign the company is in trouble. It's more like a recalibration.
That's a helpful way to look at it, differentiating market noise from actual company problems. And speaking of the company's health, let's talk financials, because the report highlights something really crucial. As of Q3 2024, Joby was sitting on $710 million in cash and short-term investments. The report explicitly says this ensures ample runway. That sounds incredibly strong for a company still deep in development, right? How important is that cash pile?
Oh, it's paramount, absolutely critical in this industry. Think about the costs involved. It's astronomical. They're funding cutting-edge R&D constantly. They're running incredibly expensive flight test programs to meet safety standards. They have to navigate this super complex regulatory maze like the FAA certification we'll talk about. And eventually, they need to build factories for mass production. All of that burns through huge amounts of cash for years before they start selling rides or planes in large numbers. So having $710 million means Joby isn't scrambling for cash right now. They're not under immediate pressure to raise more money, which often means issuing more stock and diluting existing shareholders. It gives them stability. It means they can stick to their development timeline, tackle unexpected problems, deal with regulatory hurdles without a constant financial sword of Damocles hanging over them. It's basically fuel in the tank for a very long, very expensive journey. It buys them time and flexibility.
And it's not just their own cash hoard. The report brings up another massive piece of the puzzle, Toyota. Toyota invested $500 million. That brought Joby's total funding up to nearly $900 million, $894 million to be precise. And the report connects this directly to production readiness. So clearly this is about more than just the money. It's Toyota. What does that partnership really bring?
Exactly. The Toyota investment is huge, and the value goes way, way beyond the $500 million, significant as that is. First, it's an enormous stamp of approval. Having a global giant like Toyota invest that much, that's massive validation of Joby's technology, their team, their whole approach. But perhaps even more importantly, Toyota brings something Joby desperately needs: world-class manufacturing expertise. Toyota basically wrote the book on high-volume, high-quality, efficient manufacturing with the Toyota production system. They know how to build complex things reliably at scale. That's exactly the challenge Joby faces as they move from prototypes to actually producing potentially thousands of these aircraft. Toyota can provide invaluable help with designing production lines, managing supply chains, ensuring quality control, implementing automation, all the incredibly difficult stuff involved in mass manufacturing something as complex as an aircraft. And beyond the practical help, it just lends immense credibility. Regulators, other potential partners, future customers, they all see Toyota's involvement, and it reduces perceived risk. It's like having the world's best manufacturing consultant deeply embedded in your company. It signals they're serious about production, not just design.
A seasoned co-pilot for manufacturing. I like that.
Okay, let's switch gears now and talk about how someone might actually approach investing in a company like Joby, especially with all this contest, the potential, the pullback, the partnerships. The report introduces a specific framework called the VPAR Rhythm Trading Method. It's presented as a way to find better entry points and manage risk. Sounds structured, which could be good in a volatile space. Can you break down the basic idea for us?
Sure. The VPA method, from what the report describes, seems to be about bringing a disciplined, systematic approach to trading. The core idea is to cut through the daily chaos, the constant news alerts, the social media buzz, the second-by-second price jumps. Instead, it tries to isolate what it considers critical information, and crucially, it looks for this information to line up with specific technical levels on the stock chart, what the report calls major support zones or pivot points. Think of pivot points like hinges, where the market direction often changes. And support zones are like price levels where buyers have historically stepped in, creating a sort of floor. The method combines this technical analysis with a broader view understanding the eVTOL sector as a whole, keeping an eye on the major market indices to try and manage risk while still aiming for good returns. A key goal mentioned is preventing overtrading, basically, making too many trades based on emotion or noise, which can eat away at your capital and your time. So it's about discipline, analysis, and waiting for high probability setups.
Okay, filtering out the noise, focusing on key levels and context. That makes sense. And the report goes further, offering different strategies depending on how long you plan to hold the investment: short-term, swing, and mid-term. This really highlights that there's no single right way to invest here, right? It depends on your own goals and time frame. Hashtag tag 3.2, tailored entry strategies across time horizons. Let's break those down. First, the short-term buy strategy. For someone looking for a quick trade, maybe over days or a couple of weeks, the advice is, consider booking partial profits and wait for the 2-week correction to unfold before re-entering. The specific entry point mentioned is $14.07 a pivot, and the conditions for getting back in are pretty technical sounding. Trap resolution 23 plus initial rhythm recovery plus fading selling pressure. Oh, okay. Can you translate that and the Elliott wave stuff mentioned into something a bit more intuitive for a short-term trader?
Right. Let's try. The Elliott wave part says Joby completed wave 3 at $14.70 monitor for trap 23 during wave 4 correction. Okay. Elliott wave theory, in simple terms, suggests markets move in predictable wave patterns. A wave 3 is usually the strongest, most powerful upward move, so hitting $14.70 was like the peak of that big surge. What typically follows is a wave 4 correction, a pullback, a breather. That's the 2-week correction we saw. The market digests the big move. Now, those re-entry conditions. Trap resolution 23. Think of sellers trying to push the price down. This suggests the sellers are losing control, getting trapped. Fading selling pressure means fewer people are selling, the downward force is weakening. Initial rhythm recovery means the stock's internal momentum is just starting to tick back up. So for a short-term trader, it's about spotting the moment when that pullback, wave 4, seems exhausted, the sellers are giving up, and the buyers are just starting to regain control, potentially kicking off the next upward leg, wave 5. It's all about timing that bottom bounce precisely. Hashtag tag 3.2.2 swing buy strategy.
Got it. Catching the turn after the pullback. Now, what about the swing buy strategy? This is usually for a slightly longer hold, right? Maybe capturing a medium-term trend over several days or weeks.
Exactly. Swing trading aims for bigger moves than short-term scalping. The strategy here is maintain staggered entries around $11.50, reduce exposure near prior swing highs, and prepare to re-enter on the next corrective leg.
Okay, entry zone $11.50. Conditions: sustained rhythm ascent plus market sentiment rebound.
The Elliott context is wave 4 correction around $11.50. Watch for wave 5 resumption. So the swing trader is also watching that wave 4 correction, but maybe expecting it to go a bit deeper towards $11.50, which might be a stronger support level. They're positioning to capture the bulk of the next major upward move, wave 5. Sustained rhythm ascent means they want to see more than just a quick bounce. They want confirmation that upward momentum is rebuilding more broadly. Market sentiment rebound means the general feeling about the stock needs to turn positive again. The idea of staggered entries around $11.50 is key for swing traders. You don't try to buy everything at the exact bottom. You might buy a bit at $11.75, a bit more at $11.50, maybe even a bit at $11.25 if it dips lower. It averages your cost and reduces timing risk. And reducing exposure near prior swing highs means taking some profit when the stock runs up to levels where it previously stalled, then getting ready to potentially buy back in on the next dip. It's about riding the medium-term waves. Hashtag tag 3.2.3 midterm buy strategy.
Riding the waves. Okay, that paints a good picture. Finally, the midterm buy strategy. This sounds like it's for investors with a longer horizon, maybe thinking months or even a year out, focusing more on the company's fundamental progress.
Precisely. This is less about catching short-term wiggles and more about the bigger picture. The advice is, build positions incrementally around $9, adding when rhythm indicators show renewed strength and liquidity expands.
Entry zone $9. Conditions? Expanding liquidity flows plus Dubai commercialization catalyst.
Right. And at Elliott wave angle is Wave 5 acceleration expected, fueled by Dubai service launch. This strategy assumes that Wave 4 correction could be even deeper, potentially reaching $9, which might represent a major long-term support level or value zone. The focus here is on accumulating shares patiently based on major company milestones. Expanding liquidity flows is important. It suggests larger investors, institutions are getting involved, providing more stable long-term demand for the stock. And the Dubai commercialization catalyst is a prime example of a fundamental driver. A midterm investor is betting that as Joby actually starts flying commercially in places like Dubai, the real value of the company will become undeniable, leading to significant share price appreciation over time. It's about investing in the business achieving its goals. And this really brings up that crucial point again, doesn't it? It forces you, the listener, to ask, what kind of investor am I? Are you looking for quick profits based on technical signals, that's short term? Are you trying to capture trends over weeks or months, that's swing trading? Or are you investing in the long-term vision, willing to ride out volatility based on fundamental belief? That's midterm or longer. Your own goals, your tolerance for risk, how much time you have, all that dictates which strategy, if any, might fit. It's definitely not one size fits all. Understanding yourself as an investor is just as important as understanding the stock.
That's such a vital point. Know thyself, investor. Okay, so keeping those different approaches in mind, let's talk about the big things that could really move the needle for Joby, the catalysts, and also the challenges, the headwinds they still face. First, the absolute elephant in the room for any aviation startup, FAA certification. The report calls it critical for commercial operations. Where does Joby stand, according to the source, and why is this such a huge deal?
Okay, the report gives a specific update. Joby's final flight tests are apparently 80% complete. That's significant progress. And the target for getting full FAA approval is by 2026. Now, why is it monumental? Because FAA certification is arguably the single biggest hurdle for any company wanting to fly passengers or cargo commercially in the U.S., especially with a brand new type of aircraft. It's not just about the aircraft being safe to fly. It's an incredibly rigorous multi-year process covering the aircraft's design, every component, the manufacturing process, maintenance procedures, pilot training standards, operational rules, everything. Getting that final FAA stamp of approval is the ultimate validation. It says the U.S. government deems this aircraft and the company's operations safe for the public. It unlocks commercial service. It's a massive de-risking event for investors. Any significant delays here can throw off timelines, increase costs, and really shake confidence. So hitting that 2026 target is absolutely vital for Joby's plans. Being 80% done is great, but that last 20% involved immense scrutiny and paperwork. It's still a tough climb.
Right, the final gauntlet. But while they're navigating that in the U.S., they're making very real moves elsewhere. Dubai comes up again. The report flags a big milestone. In June 2025, Joby did its first pilot conversion flight in Dubai. Well, that sounds like more than just testing, right? Like actual operational progress. The report says it's boosting commercial rollout expectations and mentions plans for 4 vertiport rollouts across Dubai. How important is Dubai strategically?
It's incredibly important. Dubai has consistently positioned itself as a global hub for innovation, especially in transportation and logistics. They're often willing to be early adopters of transformative tech. So for Joby, launching there is strategically brilliant. It gives them a high-profile, real-world stage to demonstrate their capabilities. It's not just a test flight in California, it's operating in a major international city. That pilot conversion flight means they're training local pilots on their aircraft, integrating with local air traffic procedures, basically proving they can operate within an existing complex urban environment. It makes the whole concept much more tangible. And the plan for 4 vertiports, those are the dedicated takeoff and landing spots, shows a real commitment from Dubai itself to build the necessary infrastructure. This isn't just Joby hoping, it's a partnership to make it happen. Success in Dubai acts as a powerful signal to other cities around the world. It's like a blueprint. Look, it works here. We can do this. It builds confidence for regulators, investors, potential partners, and eventually the public. It's a crucial stepping stone to global commercialization. Hashtag 4.3, broader industry risks and challenges.
So real progress on the ground, or rather in the air, in Dubai, and steady progress towards FAA certification. But as you mentioned, it's not all smooth sailing. The report is careful to point out broader industry risks. It mentions Lilium's funding challenges and regulatory delays as examples, summarizing the big issues as eVTOL industry funding constraints and approval risks. How do these wider problems affect even a well-positioned company like Joby?
That's the interconnectedness of a new industry. Even if Joby has plenty of cash now and strong partners, problems elsewhere in the sector can create headwinds for everyone. If other prominent eVTOL companies, like Lilium perhaps, run into serious funding trouble or face major unexpected regulatory setbacks, it can definitely dampen investor enthusiasm for the entire space. It might make future funding rounds more difficult or expensive for all players, even Joby, down the line when they need capital for massive expansion. Perception matters. Similarly, if regulators like the FAA or EASA in Europe encounter unforeseen challenges in creating the overall rules of the road, not just for one aircraft, but for managing potentially hundreds of these things flying around cities, integrating them with existing air traffic, ensuring cybersecurity that could delay everyone's commercial launch timelines, regardless of how ready Joby's own aircraft is. So Joby's success isn't entirely within its own control. They're dependent, to some extent, on the overall health funding environment and regulatory progress of the whole eVTOL ecosystem. A rising tide lifts all boats, but the reverse can also be true. And beyond funding and regulation, there are other shared challenges. Winning public acceptance, building out the physical vertiport networks, which will be costly, ensuring long-term battery performance and reliability. These are industry-wide hurdles.
Right. It's a whole ecosystem that needs to develop. Now, the report also touches on something slightly different, but pulse of the community and market rhythms. This feels like it gets into the more human side of investing. It pulls data from community flow indicators. Like on StockTwits, Joby apparently has over 22,000 watchers and saw nearly 100 mentions in a 24-hour period. That's a lot of chatter. And the retail sentiment score was a pretty positive buy score of 60-60-100, with message volume jumping a huge 284%. Plus, on Reddit, the Joby subreddit was actively discussing things like equity raises and funding strategy a few weeks back. What does all this online buzz actually tell us?
It definitely tells us that Joby is capturing the attention of individual retail investors in a big way. That high watcher count, the surge in message volume, the positive sentiment score, it shows significant engagement and enthusiasm from that community. And that matters because retail investors collectively can have a real impact on a stock's price, especially in the short term. High positive sentiment and discussion volume can contribute to buying pressure and volatility. It also suggests these aren't just passive watchers. They're digging into the details, discussing funding strategies, equity raises, like the Reddit example shows. They're actively trying to understand the company. However, and this is crucial, retail sentiment can also be very fickle. It can swing rapidly based on news, hype, or social media trends, sometimes disconnected from the company's underlying fundamentals. So while it's a useful indicator of current interest and potential short-term momentum, you absolutely have to balance it against the hard facts, the financials, the certification progress, the competitive landscape. Relying only on online buzz can be, well, pretty risky. It's one piece of the puzzle, not the whole picture. Hashtag tag 5.2, understanding the rhythm of the market.
A piece of the puzzle, definitely. Okay, and connected to that idea of market dynamics, the report revisits the VPAR method's rhythm analysis, applying it across those different timeframes we discussed. How does analyzing these rhythms help understand Joby's current market state?
Right. This rhythm analysis is VPR's attempt to sort of quantify the market's pulse or momentum on different scales. For the short-term rhythm, the report says it entered a deceleration adjustment phase, currently in a weakening rhythm. This matches perfectly with that 2-week pullback. It tells a short-term trader, okay, the immediate upward push is gone for now, things are cooling off or pulling back. It signals caution for immediate longs. Then, for the swing rhythm, it's described as recovering around the pivot, showing sustained ascent signals. This suggests that while the very short term is weak, if you zoom out a bit to the medium term, the picture looks better. The market seems to be finding support, and the underlying momentum is starting to build again. For a swing trader, this hints that the pullback might be creating a buying opportunity for the next medium-term upleg. And finally, the midterm rhythm. Strong expansion beyond the bands with continuing upward momentum. This is the longest view and the most positive signal described. Expansion beyond the bands usually implies a very strong established trend. It suggests that despite the short-term noise and pullback, the bigger underlying trend for Joby remains strongly positive, likely driven by those fundamental factors like partnerships and eventual commercialization. So you see how looking at the rhythm on different timeframes gives a more layered picture. The report stresses confirming the trend, rhythm, and volume on each timeframe. It's about aligning your strategy with the specific market flow that matches your investment horizon. Are you trading the short-term chop, riding the medium-term swings, or investing in the long-term expansion? The rhythm analysis tries to help you identify which phase the market is in for each of those perspectives. #tag outro.
Understanding the whole symphony, not just one instrument. That makes a lot of sense. Okay, so bringing this deep dive to a close, it's clear Joby Aviation is a really compelling company at the heart of this potentially revolutionary urban air mobility movement. They're navigating that recent market pullback, yes, but from what looks like a position of considerable strength, strong finances, key strategic partnerships, and tangible progress towards making this sci-fi vision a reality.
Absolutely. We've seen the two sides, haven't we? On one hand, that solid cash reserve, the immense value of the Toyota partnership, the real progress in Dubai, these things definitely bolster the case for midterm growth. They've got a strong foundation. But on the other hand, those industry-wide challenges of potential funding constraints across the sector, that critical, complex path to full regulatory approval, those remain very real risks that anyone looking at the space needs to keep a close eye on. The report's takeaway seems to be, view the recent pullback maybe as a tactical chance to re-engage if you believe in the long term, but stay laser-focused on that certification progress and those major catalysts like Dubai actually launching service.
It really has been quite a journey just exploring this one company. And beyond just investing, thinking about Joby's story really highlights the sheer complexity, the determination, the audacity involved in bringing something truly disruptive like this to the world. It's so much more than just having a cool invention. It's navigating global regulations, building new infrastructure from scratch, forging these massive partnerships, raising enormous amounts of capital, managing public perception. It's an incredible undertaking. So maybe a final thought for you, listening. How could you apply this kind of meticulous, deep dive approach, really digging into sources, looking at different angles, cutting through the noise in other parts of your life? Maybe understanding a new field for your career, researching a complex issue, or even just making a big personal decision. That ability to dissect information and build real understanding feels more valuable than ever. Keep digging, keep asking questions, stay curious. There's always more to learn. Thanks for joining us on The Deep Dive.